Hello and welcome to my morning note. Let's take a look at the dilemmas for long-term investors today. More or less everybody agrees that bonds look expensive, and while there's controversy over stocks, very few people think they look particularly cheap. Meanwhile, as we all know, the demographics for pension funds are getting ever more difficult. So what is an investor to do? Well, this report, Investing in a Debt-Fueled World, is a fascinating survey of some 700 investors trying to look at what measures they're taking. It was commissioned by Principal Global Investors, whose CEO is with me to discuss it now. He's Jim McCaughan. Jim, thank you very much for joining me today.
Thank you for having me.
Let's start by taking a look at a forecast produced by Dimson, Marsh and Staunton for the London Business School. Basically, they're predicting that bond returns are going to be awful compared with history for the next few decades, and that stocks are certainly going to perform much worse than we have become accustomed to. Do you agree with that general assessment?
I think the way to look at that is that the long-term return is extremely sensitive to the starting point.
Yes.
And if you look at the periods in question, 1980 till about a few months ago was a most extraordinary 30-year plus bull market in high-quality bonds. That ended when the US Treasury yield went down to about 150.
Yes.
It's probably not going lower. It's probably going higher. And that takes quite a bit off the long-term return.
Yes.
On the other hand, equities, well, I think you could argue that that's maybe on the conservative side of things. But, you know, again, it's dependent on the starting point. Both 1950 and 1980 were pretty low points in the market. Now, I would argue, is about average in terms of valuation. So I wouldn't argue strongly with those, although I think equities may be a bit better.
Now let's take a look at what your survey suggested about what investment managers are planning to do about it, and perhaps not surprisingly given what you just said. If we're looking at asset allocation for the medium and long term, they still like going into global equities. But quite a lot of the other things we see on this list are really quite surprising appearances for pension fund managers. For example, alternative credit and real estate both appear high up.
Yep.
Are they moving beyond their core competencies?
I think it's very important that investors use managers who have those areas as a core competence. But there is an overall theme here, which is the weakness of the global banking system means that these forms of capital are not being as effectively provided by the banks as they used to be.
Right.
So real estate debt, distressed debt, emerging market debt, all of those areas used to be the province of the big global banks. Looking forward, there is an opportunity for investment institutions to step in and fill the gap. That will be a rewarding opportunity, I believe, but they need to make sure they have the skills to do it.
So it's not ultimately a demand from the final investor, it's almost a kind of a push from the people who are needing the capital. They're pricing the capital so that there's an opportunity.
Yes, and that creates the opportunity.
Now let's take a look at the investments which showed up as being least appealing to investors for the medium term. The red bar here, however, shows where people think it could be an opportunity for an opportunistic short-term investment. What do you make of this list? ETF, similarly regarded as a great tool for messing around in the short term.
I strongly suspect that if you redid the survey 6 months on, 5 or 6 months on, you would find that the appetite opportunistically for commodities, including gold, would be a lot less than it was then.
Right.
Just because the price has been so weak. I do think, though, that part of the reason why commodities, and particularly gold, have really been quite weak is that the cost of holding it is now much greater. Many of the investors who hold gold also have borrowings.
Right.
Those borrowings are going to get more expensive. Rates have gone up faster than most people expected. I think that's the reason why several commodity prices have gone down. In terms of ETFs, ETFs are not what they were. ETFs used to be a cheap way of getting beta, of getting market exposure. Now they're much more used tactically in terms of creating active asset allocations. And I think that's why ETFs have moved from the asset allocation category to the opportunistic category over the last 3 or 4 years of the survey.
Okay, Jim, thank you very much indeed.
Thank you, John.
Okay, we do seem to have a different landscape for pension funds for the future. Perhaps given that there is reason to be nervous about both bonds and stocks for the medium and long term, it is quite encouraging that they are already finding ways to adapt to that new environment.